everyone, and welcome back. My name is Greg Furman, and this is the Forex Weekly Outlook for the week of September the 26th, 2016. Now, to get started this week, we'll begin where we always do with the key US dollar index. Now, we've come out of the Fed announcement this week. Basically, the market's kind of very undecided again. What is the Fed doing? Are they going to hike? Are they not going to hike? In my respectful opinion, guys, we should basically just disregard a lot of what the Fed is saying at this particular time. I think they're trying to basically artificially weaken the US dollar so they can strengthen their precious equity markets. That's what they tend to do here, guys. And usually when the Fed tries to weaken the US dollar, the dollar comes back even stronger. We've seen this with the Swiss franc, we've seen it with the euro, we've seen it with the yen, we've seen it with a number of different currencies. So we have to keep this in the back of our mind when we're doing our trades here. Now, to begin the week here, we've got the dollar in a very mixed signal from the dollar here, and that's what we should be looking at. Now, with a lot of activity around the triple EMA cross, we can see 95.49 is the key VantagePoint level. We've closed slightly below that at 95.39, but you can see that we're still in this Brexit range that I've talked about for these last several months here, guys, that absolutely nothing has changed. We are range bound on the dollar index, we're range bound on the euro, the Swiss franc, the yen, all of these pairs. So we have to still respect that range. Now, the one signal that bothers me here with the dollar here is the medium-term predicted difference crossing the long-term predicted difference. Our neural index is pointing down, so it's telling me the immediate near-term move on the dollar is going to be to the downside, but in almost every case, the dollar has rebounded midweek regardless of what the Fed has said. So when we look at this, we can see the predicted RSI is starting to turn flat here. We're at 47, so we are bearish. We're below 50, but we're not showing any kind of significant momentum. Like momentum, what I'm talking about here, guys, is a break of the 40 line. If we connect this to the triple EMA cross, that showed a big move down in the dollar index, but we don't have that. We're actually flattening out here. So we've got a very, very mixed signal. We've got our predicted MACD sitting still above the zero line and holding, but again, our medium and longer term trends are weakening on the dollar to some degree. So not surprisingly, that's pushing the equity markets back up off the bottom. Now, the case in point here that I've talked about last week is how important this breakout point from the Brexit was. So you can see when we broke out through this area here, very important that we notice what's happening. Now, when I've talked about this over the last couple of weeks, we're coming down and we're getting all caught up right on the top of that breakout point, which is just above this 2100 mark, and now we're starting to turn higher again. But our neural index, our predicted short, medium, and long-term differences are very, very conflicted here. We've got a crossover in our predicted MACD, but still below the zero line. We want this back up above the zero line, and our predicted RSI is not holding above 60. It's pushing back inside of that 60 level trigger. So we've got a problem here also. So nothing is clear cut, and it never is after the Fed, guys. The Fed just simply, in my respectful opinion, does nothing but interfere with the free markets. That's what these central bankers do. And of course, over these so many years that I've been on here on Trader Planet, I've repeatedly discussed how I have issues with them doing this. But I have no control over that. So we have to see how the market is going to continue to digest what the Fed is saying. But I think ultimately they are likely going to hike in December. Nothing has changed here. Okay, guys, very important. So the global equity markets, we can see the DAX, the European equity markets also getting a little bit of a boost, but not from demand because of what the Fed has stated. The same as the Nikkei, but the Nikkei is one that certainly is worth talking about in our Forex trading because it has such a huge effect on the US dollar yen pair. So right now, we can see here that we are not holding above this 17,000 mark. Our breakout point here comes in at about the 16,800 mark. We are closing below that. And the indicators on the Nikkei are turning lower again. Our predicted MACD is breaking below the zero line. We've got a failure here at the 60 line on the predicted RSI, and we're starting to move lower. So this would tell me that it's going to be very difficult for the dollar yen to rally as long as the Japanese equity markets are going lower. So we have to respect these things. Now, when we look at our major commodities and how they're affecting the Forex market, any move in oil is affecting the British pound, and it's predominantly affecting, of course, the US dollar and the Canadian dollar. So when we can see here that when we look at this from the breakout point from the Brexit, again, we've come up, we've had a retest rate here. And in this last week where it looked like oil was really starting to rally back up to the 46 mark, it just gets hammered lower again on Friday, which is, in my opinion, the real price in this particular case. But we do have some interesting signals from VantagePoint. The medium-term predicted difference over the long-term predicted difference. We've got the neural index going down, predicted MACD going down. So I don't think a lot has really changed in oil at this particular time here, guys. As I've said for the last 3 or 4 weeks now, that basically it's tough to make a bullish argument at this time of year for oil, when oil is predominantly weak and clearly supply is high and demand is low. So right now for next week, 45.28, that's the key level we want to watch. Now, when we look at gold, once again, we're getting a makeshift buy signal here, which I don't think is necessarily wrong, but I think that the rally in gold is going to be very short-lived. Our key VantagePoint level is coming in at 1326. We've closed at 1337. Slightly above that 18-day predicted EMA, but once again we can see that our indicators are really struggling here. There's our medium-term predicted difference again, crossing the long-term predicted difference, but can it move forward here after, or is this simply a knee-jerk reaction to the Fed? I would say the latter is much more likely here, guys, because really gold is just stalling out. We can see once again that Brexit high. We've had a bit of a break right here, only for it to go back down. We come back up, retest the exact same level, then we go down again, then we come back up, but this time we didn't get up as high. Now people will try and pin this to Fibonacci, to Elliott wave, to a lot of different things, but guys, the Brexit high, that's all we're talking about here. So we can say that this is an Elliott wave move, a Fibonacci move. We can come up with all these wild and wacky theories here. It's the Gann theory. What else can we throw into the ring here? The fact of the matter is the Brexit high is where gold basically produced the majority of its gains, and it's struggled ever since to hold on to those gains. So we do have pretty strong support though at the 1300 mark. I don't know if that will continue to hold or not, but I think ultimately the market is going to move back towards that US dollar. So that's where we have to keep a very close eye, because when we're trading Forex, guys, we're not just trading Forex. We're trading stocks, we're trading commodities, we're trading a lot of different things. So we definitely want to keep this in mind. Now, as we come into our major currency pairs here, starting with the Euro US, you can see I immediately move my cursor line to to get my key pivot areas here. When I look at this right now, we can see our 18-day predicted EMA 111.98. We've had a very weak close at 112.25. Just because it's above that 18-day predicted EMA doesn't mean it's super bullish here, guys. We are still trapped in this Brexit range right here. Now, we do have the ECB this week, which will probably put a little weakness into the euro, but again, we are trying to produce a buy signal here. These patented indicators from VantagePoint, the short, medium, and long-term predicted differences, it is showing some signs of strength here, and of course our predicted MACD holding above the zero line. Our predicted RSI, we're coming in at 53, so we are still mildly bullish, but we really, if we're going to see some momentum here, guys, we've got to break here above this 60 level. This is what we really need to do, okay? Very, very important that we can break above that with some kind of momentum. At this particular time, I think that is very unlikely, and the euro will continue to range trade, as will its counterpart, US Swiss franc. Now, US Swiss franc, that breakout point, a number of concerns again right now. You can see that we failed on this Brexit high. Again, we had a breakout right in this area here. We tried to break it right here. This time, we're basically going right along that Brexit high area, and we've got a triple EMA cross from VantagePoint. That is a problem because the triple EMA cross is to the downside. Now, 97.49 is the key level. We've closed at 96.97. We've got to basically, I think we're going to have a little bit more downside on this, maybe the first couple of days into the new week, next week, of course, and then we're likely to see this thing reverse yet again. In my respectful opinion, all we're doing here, guys, on this pair is range trading. So the indicator is very mixed here, but you can see that we're trying to break below that 40 level on the predicted RSI, and we're not doing that. We're holding above this area, okay? So unless this predicted RSI can start pushing lower, the predicted MACD can start moving, I think we're simply going to form another trend line probably around the 96.30 area. Buying into that area is still a reasonable play. Now, as we come to pound dollar here, pound dollar, very interesting pair. It's really had a tough go these last few months on Friday. Friday, we sold off again here, but in my respectful opinion, that was triggered by the sell-off in oil. Oil moves lower, the British pound moves lower, US CAD moves higher. Now that we can see that after the Brexit, the breakout point, we've had a bit of a move back up. 135 is capping any kind of rally, but we're seeing, I'm seeing very, very significant support at the 129 level. So until we can break this very tight range that we've been in between 125 and basically about the 128.50 area, a sustained break on one side or the other, we are likely to continue range trading. Now, again, what I'm going to point out is we have a mixed signal here. We have the medium term crossing over the long term predicted difference, saying the move to the downside is weakening yet again. So this is telling me that this range trade is likely to continue at least for a few more weeks. Now, the predicted MACD crossing the zero line, absolutely a concern. My biggest concern for longs is the fact that we have failed on the 40 level on the predicted RSI. That is a big concern for me for any kind of long trade. But with my own direct clients, again, we're going to stay long basically between the 128.50 and the 129 level on this range, very identifiable range bottom over the last 2.5 to 3 months here, guys. So again, we want to, stay with the market flow. We're going to need something, some big rhetoric out of the UK or out of the Bank of England to really trigger a more significant sell-off on this particular pair. Now, as we move over towards the dollar-yen pair, as I discussed at the beginning of this presentation, that basically the dollar-yen is going to react to the Nikkei. So if the Nikkei is going up, dollar-yen is going up. If the Nikkei 225, the Japanese stock markets are going down, dollar yen's going down, which means money is going into the yen. We do not want to lose sight of this here, guys. Okay, so the critical levels to start the week here, we've got this 18-day predicted EMA, which is 101.73. We are closing well below that, guys. So only a sustained break of 101.73 at this particular time will take the pressure off the downside. But once again, we are still range bound on this Brexit bar. The yen made most of its gains both to the upside and the downside off of this Brexit bar. That is just a fact, guys. That's not me saying it. That's the market saying it. So since then, we have basically been going sideways with a very clear downside bias. You can see we've come back up here. We've hit our top, come back down, had a much, much lower high right here, and now we're on our way back down again. So the key level I think to watch here next week, is are we going to hold above the 99 level? Well, again, in my opinion, based on what I know of intermarket correlations, that is going to be determined by the global equity markets. If the global equity markets sell off, we go into a risk-off environment, then the dollar-yen is going to come under pressure. That's just simply how this works, guys. That's how Forex trading works. The intermarket correlations often trump any other indicator on the screen that we're using. So we have to look at this very closely. Right now, our medium-term and long-term predicted differences are absolutely flat. Our predicted MACD is breaking below the zero line, and we're at 33.3 on the predicted RSI, all of which are bearish. So we'll watch this very closely, but this range bottom down around 99.50, only a sustained break of that will we really see a breakout play. So there could be a long here. If the S&P moves higher, the Nikkei moves higher, then this could be an absolutely excellent long trade next week. But my optimism on that at this particular time remains heavily guarded. Now, when we look at our going into our final pairs, our commodity currencies, US CAD, when we look at the US CAD, our critical level 130.91, we've closed the week, we've fought our way back here, all the way back up to 131.67 to close the week. Above that key VantagePoint 18-day predicted EMA. This is absolutely critical that we hold above this. Now, this big move back up was, a lot of this was to do with oil prices getting soft yet again, failing there, and oil moving down into the $44, $43 a barrel. That immediately weakened the Canadian dollar and sent it higher. So if you're trading US Canada, guys, whether you like it or not, you're trading oil. That's what you're doing. You're trading a number of other commodities. Oil, you're trading gold, you're trading silver, iron ore, a number of these different things. So when I look at this for next week, it still carries a mild bullish tone to it, but we have to see those oil prices continuing to stay low. If oil recovers at some point in time, then the Canadian dollar will likely recover with it, but we are certainly far from that right now. We have a very significant top here around 132.50. We must break through this level and get past this, guys. If we can't break 132.50, US CAD's going to go, it's going to drop again like a wet bag of cement. So be careful. We can buy up towards that 132.50, but we have to break through it sooner rather than later, and that's very important. Now, our predicted MACD is recovering. We can see our medium-term predicted difference starting to turn back up, and our predicted RSI at 58.8 is starting to look much, much better here, guys. So we'll see how this one starts the week, but it is absolutely going to be determined by oil prices as to what happens with this particular pair. That indirectly will also affect the Aussie pair and the New Zealand pair. The Aussie currency, once again, guys, I'm trying to make sure I point everybody to this. I probably sound like a broken record to some of you guys about this Brexit bar here, but once again, I've talked about it each week. We need to hold above 76.50. We are not doing that. We've had, even after the Fed, the best we could do was to get slightly above it, only to turn around and fail on Friday's bar. Our neural index warned us. Even though the market was moving higher, we can see that our neural index is telling us something's not right. The market's going higher, but the neural index is going lower. So for anybody watching my videos, the medium term crossing over the long-term predicted difference, following this up, there was your buy zone, down around 75. But up here, guys, until we can just break free and clear of the 76.50, 77.50, just break free and clear of this area, all biased is still clearly to the downside. Now, I don't dispute our indicators are mixed, our predicted MACD, the predicted RSI. A lot of this is still very, very mixed, right? So when we look at this, watch this Brexit high. They're going to try and fight this out again, and this is going to be a critical area to break free. Break free of 76.50, break free of 77, and just get out of this area altogether is what we need to do. And again, in my respectful opinion, the same will apply next week to New Zealand US. You can see New Zealand US, it's had kind of a rough week, but we continue to fight all around this bar. You can see in indisputable what I am saying here, that there is no special indicator up here of any kind. We've got the Brexit high bar. That's what we have. The market is sold off. It's gone up. It's come back down, touched the bottom range of the Brexit, come back up a little weaker, but the VantagePoint has kept us long on this right here, but then we've had multiple failures here, and we can see the predicted differences. The medium-term predicted difference crossing over the long-term predicted difference. Every one of these times warned us that something is wrong with this uptrend. Well, guys, it's starting to show the exact same signal yet again. So what we need to do here for next week, we have a secondary level of support that's coming in at about the 72.30 area. If we lose this area here around the 72.50 area, 72.20, right in and around that area, then and only then will we see a much bigger move to the downside. We still have buyers coming back in here, but the Bank of New Zealand, they're getting very dovish also. So a lot of this, it's basically a global war between these central bankers. Everybody's trying to weaken their currency, and every time somebody tries to do this, it usually usually, I'll stress that, fails. So for next week, we once again, we have a very tricky week ahead of us, but not as much US data, I think, until Friday, where we're going to see the US GDP number. We're going to see the Canada GDP number, and of course, we're going to have the ECB next week, which will be a big mover for the euro. If the euro sells off hard, then the dollar is likely to gain right across the board.